Europe is in the middle of a triple crisis: a currency crisis, an energy crisis, and an industrial crisis. When it comes to currencies, everyone hopes for a rise in value, but for the euro, it's been the reverse. In fact, we're almost back to where we were in 2022, with the euro hitting one-year lows and sparking new worries that it could drop to the $1 mark. This means it now takes more euros to buy the same goods in dollars. For the industrial sector, energy-intensive industries like chemicals, steel, and aluminum have responded with production cutbacks. Even when energy prices eased, many of these industries only partially resumed operations. Some businesses have even made the tough decision to shut down permanently or relocate to regions with cheaper energy costs. That's not a good sign. Deindustrialization in Europe is already happening. This November, business activity in the Eurozone experienced an unexpected contraction, largely due to a significant downturn in the services sector, often considered the backbone of the economy. This downturn is captured by the Flash Eurozone Composite, PMI. Think of it as a report card for the economy. It dropped from 50.0 in October to 48.1 in November. Anything below 50 means contraction, and this is the steepest drop we've seen since January. The services sector officially shrank for the first time in 10 months, with its PMI dropping to 49.2 from 51.6. Meanwhile, manufacturing continued its losing streak for the 20th month in a row, with November's PMI down to a bleak 45.2. Usually, in these cases, trading balances things out with exports bringing in cash for the economy. In this case, export orders are also nosediving, putting even more pressure on businesses. In the third quarter of 2024, imports rose slightly by 0.5%, but exports fell by 1.0%, the first decline since late 2023. As a result, the EU's trade surplus in goods shrank from 38 billion in Q2 to 29 billion in Q3. Yes, it's still a surplus, but it's shrinking fast. What does this mean for you? Well, if you're eyeing that pricey gadget or luxury item, maybe hold off for now. But will 2025 be any better? That's the real question. They say a picture is worth 1,000 words, and if you take a close look at the graph in front of you, it paints a pretty clear picture of the euro's struggles over the last 5 years. Right now, the euro is trading at $1.05. Now, if you're wondering whether the euro can hit parity with the dollar, it might interest you to know it's very possible. The euro is just 6% away from that key $1 mark, and it's been there before. Can you remember the early 2000s? Or more recently in 2022, when Europe was struggling with sky-high energy prices after the war in Ukraine, and the US was aggressively raising interest rates? Both times, the euro dipped below the dollar. But why is this $1 mark so bad? For traders, it's more psychological than the numbers. Crossing below $1 can shake market confidence and push the euro even lower. It's like a domino effect. One drop could lead to more. And big financial players like JP Morgan and Deutsche Bank are already saying it's a real possibility, depending on what happens next. What is keeping the euro down is not as simple as we think. It's a mix of weak economic performance, inflation that's failing to hit targets, and political uncertainties. The US is one major chess piece in this game. With Trump's potential policies back on the horizon, the euro has already taken a hit. It dropped 2% to 1.07 after US polling stations closed, a 4-month low. But we'll come back to Trump shortly. If the United States cuts taxes, that can fuel inflation, which might stop the Federal Reserve from slashing interest rates. That would make the dollar look even more appealing to investors compared to the euro. Now let's go back to Trump and his America First approach and what this means for Europe. First, Trump's plans for tariffs and his push for European allies to pay more for defense are already questionable. Why? Because these policies directly challenge the very foundation of international cooperation. If tariffs are imposed, they could hurt European exports, slow down growth, and make the dollar even more attractive to investors. When global growth slows down, investors flock to safer assets, and the US dollar becomes their go-to. This puts even more pressure on the euro, which is already struggling. This is the psychological breaking point we mentioned earlier for many traders, and it could send the euro down even further. But it's not just about trade. Trump's unpredictable style and focus on transactional deals could leave Europe high and dry. What do we mean? Imagine this. NATO is weakened. Nationalist movements are emboldened. A potential trade war across the Atlantic, and disputes over Europe's regulations on things like social media, AI, and cryptocurrencies. It's a recipe for chaos. European leaders like Poland's Prime Minister Donald Tusk have foreseen this and are sounding the alarm. Poland's Prime Minister Donald Tusk didn't hold back recently, saying, The era of geopolitical outsourcing is over. In other words, Europe can't count on the US to be its protector or partner the way it used to. It's time for Europe to step up, strengthen its defense, and start standing on its own 2 feet. France has been advocating for this kind of strategic autonomy for years, but many EU countries are hesitant. Why? They fear it could weaken the transatlantic bond, something Europe has relied on for decades. Now, Europe's industrial backbone is also tied to that bond, and right now, that backbone is starting to crack. As the European country with one of the highest shares of manufacturing in GDP, Germany's fear of deindustrialization is real, and for good reason. Deindustrialization, in simple terms, means a shrinking role for industry in creating wealth. Let's talk about the so-called engine of Europe's economy, which seems to be running out of fuel. According to Martin von Sleben, the chief executive of the German Chamber of Industry and Commerce, AHK, the problems are clear. Too little investment, too much bureaucracy, and excessively high location costs. In other words, doing business in Germany is expensive, slow, and unappealing. And it's showing. Take Audi, for example. The car maker recently announced it's closing its Brussels plant in February 2025. For Stavros, a union rep who's worked there for nearly 40 years, it feels like a betrayal. "We're furious because we're being discarded," he said. And Audi's decision is far from an isolated case. Europe's car industry as a whole is feeling the heat from sluggish growth and tough competition, especially from Chinese models. It's been a tough year for the sector. Since 2024 began, we've seen a wave of announcements about job cuts, production slumps, and plant closures. Stellantis is scaling back in Italy, Michelin is cutting operations in France, and Volkswagen, Germany's pride, is shutting down 3 production sites at home for the first time. The decline has been building for years. If you look at monthly industrial production data, things have been going downhill since late 2017. Sure, the COVID-19 pandemic made everything worse, but the Ukraine war has added even more pressure. And then there's foreign investment. International companies invested just $22 billion, that was equivalent to $24 billion in Germany in 2023. That's the lowest amount in 10 years. So why aren't companies flocking to Germany anymore? Christian Rusche, an economist at the German Economic Institute, says, "Politics makes it anything but attractive for companies to invest in Germany. Germany's current government, which is a mix of social democrats, Greens, and pro-business liberals, is struggling to agree on industrial policies. Instead of creating a conducive, business-friendly environment, they're bogged down by disputes. When you add that to the rising costs of energy, raw materials, and labor, you have a recipe for stagnation. And let's not forget the skilled labor crisis. Germany is on track to lose 7 million skilled workers by 2035 out of a total workforce of around 46 million. That's massive. If you're a business looking to invest, the thought of not having enough skilled workers to power your factories or innovation labs is enough to change your mind. Now, if you go northeast of Germany, you have France, with its own fair share of issues. It's a slightly different story, but no less concerning. France has been dealing with deindustrialization for years, and the focus now is on reversing the trend. They're turning to reindustrialization to strengthen their economy and reduce dependence on imports. This sounds great on paper, but the reality tells a different story. In September 2024, industrial production in France dropped by 0.63% compared to the same month last year. Agreed, it's a small dip, but when you're trying to rebuild your industrial base, every decline stings. As usual, let's look at the dramatic numbers. In 1991, industry accounted for 28.8% of the EU's GDP. By 2023, that number had dropped to 23.7%, an 18% decrease over 30 years. And the latest figures from Eurostat don't offer much comfort. In September 2024, industrial production fell by 2.0% in both the euro area and the EU compared to the previous month. Year on year, the decline was even sharper, down 2.8% in the euro area and 2.4% in the EU. So, what's driving this decline? As you can see, it's a lot of things jumbled up in one. Automation is cutting the need for labor, and companies are relocating to cheaper regions. The shift to a service-based economy, shrinking purchasing power, rising energy costs, and fierce competition from China and the US aren't helping either. Speaking of China, let's look at how tensions are adding fuel to the fire. The Eurozone has a toxic relationship with this manufacturing country. For years, European manufacturers relied on cheap Chinese exports like parts and components to keep production costs down. But times are changing. China has moved up the value chain and is now exporting finished goods. directly competing with Europe in global markets. Now Europe's share of global exports is shrinking, while China's is climbing steadily. Since 2021, China has been a major factor behind the Eurozone's reduced competitiveness. How? A key measure, the real effective exchange rate, otherwise called RER, shows that Eurozone products have become pricier compared to Chinese goods. And this is not because of currency fluctuations, but due to rising production costs in Europe versus cheaper alternatives from China. 2 decades ago, China stuck to low-value exports like clothing and footwear. Back then, it mostly competed with Southern European economies. But now, China is playing in the big leagues, producing specialized machinery, high-end electronics, and even the automotive sector. And if that wasn't enough, tensions between Europe and China over tariffs on Chinese electric vehicles are adding to the strain. European manufacturers now face a double-edged sword. Cheap Chinese parts still help keep production costs down, but they're also competing head-to-head with affordable, high-quality Chinese finished goods in global markets. But let's hit pause on all this talk about China, the US, and other global players for a moment. The real question is, what's next for the EU? As 2025 approaches, Europe finds itself at a critical crossroads. Could things turn around in the years ahead? Honestly, it doesn't look likely, and the numbers make that painfully clear. Take a look at the projections for the EU industry heading toward 2030. Both electricity and gas prices for industries are expected to remain painfully high, leaving little room for recovery. This is troubling for sectors already struggling to recover. Industrial gas consumption remains weak, and the warnings from European industry are getting louder. In 2025, it risks being crushed between a rising China and a protectionist United States. With soaring energy prices and mounting competition, the Eurozone is in survival mode. So, can the EU pull off a comeback? Will the euro hold its ground or sink even further? Let's hear your thoughts. Drop a comment below. And don't forget to hit that like button and subscribe as we break down these wild economic times together.